What up? It's your boy Carlo back at it again. So today I'm gonna be doing a Vanguard update on my personal account. So let's go straight into it. Starting off, so the beginning balance of the year was 56,029 and 27 cents, and the investment returns was 8,070 and 93 cents. So the return on investment year to date is around 14%, which is pretty good. I know that the S&P 500 as of today is around up 16%, so a little bit slightly below it. So I like to use the S&P 500 as a benchmark to gauge how well I'm doing with my personal investment accounts. So as you could see, from the beginning of the year to now, the economy has been doing really, really well. I know the last quarter of 2018, from September all the way up to a little bit of the beginning of December, definitely was down, and then the market rallied up a lot. So we're definitely reaching again all-time highs for the market, for specifically for US equities. So looking right over here, market gain, income, so dividends, dividends, capital appreciation, personal return, and then overall cumulative return. So doing pretty good. So I'm really happy with that. So going on to the next one. So right here are all the ones that I do have in my portfolio. It definitely looks disheveled and disorganized based on, for me personally. So the ones that I plan to keep in my portfolio is number one, the Vanguard Growth Index Fund. So basically S&P 500 index. Also, what I plan to keep is a Vanguard High Dividend Yield. So this one, I believe the dividend yield is around 3.6%. And then, but this one is Admiral share. So I believe the ticker was VDHYX. And then I converted it into the high dividend yield. Say that fast. High dividend yield Admiral shares. I think I did pretty good. Anyways, the expense ratio is going to be a lot smaller, so hence you're going to be saving a lot more money, especially with higher money that you do invest with them. So I converted that, so that if you looked at my previous one for my March Vanguard update, I believe the expense ratio is a lot higher. So this one's a lot lower, hence saving money, and they are definitely identical. If you guys haven't already done so, Vanguard was making a lot of their Admiral shares more accessible to common investors who don't have as much money to invest $10,000 or $30,000, whatever the minimum to open the mutual fund. So they made it a lot more accessible. Hence, I believe they lowered it down to 3,000. Thank you, Vanguard. And the other one that I plan to keep is Vanguard International Growth Fund, just for international exposure. The ones that I do plan to get rid of is this one right over here, Vanguard US Portfolio Growth Fund. If you looked at my previous video, it was the Vanguard Morgan Growth Fund. So Vanguard has been trying to, I guess, quote unquote, trim the fat, make a lot of their mutual funds more conducive and just less in sense. So they merged the Vanguard Morgan Growth with the Vanguard US Growth Portfolio Fund. The main reason why I plan to get rid of this one is because it has a lot of overlap with these two, with my US equities in this area, as you could see. So with fund overlap, basically you're investing in the same companies, and why am I going to pay a 0.38% when those stocks that they own in this fund are in the same ones over here? Hence why I definitely want to get rid of this guy, and it's a lot more expensive to be a part of it. Yes, it is actively managed. However, I feel that it's more cost efficient to invest with these instead of just being so overlapped in my mutual funds that I do own. I also plan to sell Vanguard Wellington. Yes, it is a 60-40, a 60 stock, 40% bond, but my risk appetite is a lot higher. I'm still pretty young, so yeah, I know everyone's gonna say, if the market takes a shit, you're gonna feel it. So, but I'm young. I feel like I could take a hit, but knock on wood that it doesn't hit me too hard. And the other ones that I plan to get rid of is the Vanguard Emerging Markets, as well as the Vanguard. Which one was it? Vanguard VYMI. So I wanted to test both of these out to see which one was going to do better. And the verdict is VIGI, International Dividend Appreciation, way better than the VYMI. So gonna get rid of this guy. I'm gonna keep holding on to this one until it goes south, and I'll just cash it out as a profit. But the main reason, these are all international equity, so definitely gonna get rid of these two because I already have it covered over here. So again, just a last recap, definitely gonna trim my holdings and make it more spot on. As of year to date, 14% return on investment. Pretty good, not too shabby. One thing that I just definitely want to leave you guys off at, make sure you put the ones that have high dividends as well as high capital appreciation in a tax deferred account. I messed up when I did this. So definitely any of you guys any new investors, beginners, or just people who want to be more tax efficient with their investments, please do this because I messed up on this part. Yeah, and just one last recommendation: don't have too many mutual funds or ETFs because it's just a lot harder to manage, and you don't want to have too much fun overlap. I hope you guys enjoy this video. Make sure to hit that subscribe button just do it right now, and that like. Anyways, I'll see you guys next time. Peace.